All right, welcome back to accounting. Today we're going to go over chapter 2, what is accounting? Okay? Well, what is accounting? We already kind of covered it over yesterday, right? But in this case, right, what is accounting? Accounting is a steps or procedures, okay, a process, whatever you want to call it, of recording, sorting, analyzing, interpreting, whatever ing words. Sorry about that. And it is going to be in terms of doing all of that for business transactions or business events. Okay, so we said collecting, right? We need to gather our resources to be able to recognize that a transaction has happened, okay? And what we do with that transaction is we are going to analyze it, understand what is the purpose of this transaction, and we're going to record it, and that is what accounting is. Okay? If you guys actually know it as blatant terms, okay, meaning in a way that you guys can understand it is, yes, it is dealing with numbers. When you buy something, how do you understand that? What's the purpose of you buying this? And how do I organize it in a way that it reflects in my books, right? If it's a dollar for dollar amount, that's exactly what we're doing. We're taking our transactions, right, and we're understanding and putting them in places so that it makes our ideas a little more organized, okay? So as a reminder, we are looking at financial accounting, okay? We are, again, the other types of areas of accounting is going to be like taxation. If you prefer and like taxes, go ahead. Tax is something that's your thing. You go ahead and can do that, right? Managerial cost accounting, right? Where we look more in depth in a manufacturing costs and things like that, and forensics. But again, we are in financial accounting. Now, when we talk about understanding accounting, we have to also understand it like it's another language, okay? There are a few key words that we use in accounting that is, in essence, going to be translated into what it means in the real world, right? So in this case, when we see receivables, that means to receive, or to receive, as in receive money. Okay. If we have to pay something, it's an expense. Okay. If we owe something, it's a payable, meaning again. And then when we have something that we own, like a property, it's an asset. Okay. So that means if I got building, if I got a furniture, right, that's all property to me. That's going to be an asset. And then anything that's an obligation is a liability. Okay, so again, you're going to be learning a lot of key terms, because essentially when we look at accounting, it is essentially learning another language. You need to understand what some of these words mean, right? Okay, but again, as we go through it, we will learn and pick up the language as we go. Okay. So let's talk about the very, very first thing is going to be accounts. When we deal with accounting, you need to know what accounts are. Okay. Now, in this case, accounts is some kind of meaningful way to organize your transactions into 5 sections or 5 topics, I guess, in this one. So in this case, right, we have 5 things that make up the accounts, and that it's the assets, liabilities, equity, revenues, and expenses, okay? Now, when we understand these 5 types, right, these are called account types, this is how when we see a business transaction, we need to organize it by account type, because at the end of the day, a transaction is going to affect one of these account types, right? And so in this case, right, I will break down each and every single account, what it is, and what you do with it, okay? So in the first three, your assets, liabilities, and your equity, we call these your permanent accounts, okay? Permanent accounts means that they are never going to close out at a given accounting period. So never close out. Now, a great example is a bank account. A bank account is an asset, all right? Can you ever close out your bank account while you're doing business?
Well, you shouldn't, right?
Well, if I close my bank account while I'm doing business, what does that tell everybody? Bankruptcy, but then again, it's good. It tells me I'm no longer doing business. So that is one of those great examples for you guys to understand that that means your bank account will never close out at the end of a given accounting period. Okay? Same thing with a loan, right? A liability, right? Can I ever close out a loan without paying it? In this case, no. They're going to come after you regardless whether you can afford it or not. Okay, the only option that you have there is obviously filing for bankruptcy, but in this case, we're not looking into those cases, but you will never ever be able to close out a loan. Okay, where here, okay, where we have our revenues and our expenses, right? These are called our temporary accounts. These close at the end of the given accounting period, right? So when we talk about temporary accounts, the reason why they are temporary, okay, well, think about it. Our revenue, we close them out because it is a form of way that we can test for profitability, okay? It's a perfect way to measure profitability. So in essence, right, when you're thinking about a revenue, right, a revenue is when we generate income into the business. Can I predict that I'm going to create the same exact sale every day? No, because you're always going to either have new customers, right? You're going to have old customers. You're going to have maybe customers that don't want to come back to your store anymore, right? You're going to lose customers. And that's exactly it. Well, in this case, revenues, right? Yes, you could have a customer that comes into your store and orders the same thing over and over and over and over. But in this case, can you predict when they come back in again that they're going to want the same exact order? You can assume so, but what if one day that person was like, give me something different, right? Then that is exactly why revenues is so important to close out, because again, it's always going to fluctuate, right? And you can close them out because what does that actually do for your business? Nothing. You've collected all your sales. It's already been done. You sold your items already. So at this point, it doesn't really affect anything that's in regards to your bank account, your loans. It has nothing to do with it except for the fact that you collected money. Okay? Same thing with expenses, right? Can I have the same expense occur every single month? Yeah, you can have what's called a fixed expense where you have rent, right? That's consistent for X amount of months. But then again, especially with rent expense, right? You're always going to have to go into contract and agreement terms with your landlord. They may raise the rent price. They may drop the rent price in any occasion for so, okay? So in this case, yeah, you'll have a fixed expense, but sometimes it can fluctuate. And then another example for an expense is, what if, in the month of June, there's no holidays in the month of June. So that means is it okay for me to go ahead and do marketing materials? You can, but is that going to make your business any better? Not really. Whereas when the July rolls around, right? You have 4th of July. That's where you can, you know, have a sale for the 4th of July sales, right? And create marketing materials for that. So in this case, I have an advertising expense for the month of July, but not for the month of June. Okay? So in this case, you can't really predict your expenses as well because every month or, every single day could be different. Right? And that's a perfect way when an expense is done, right? Whatever it is that you need to operate your business, right? Once you spent the money, that's it. You can't go back at that point, right? You can't return items and expect to get your money back just because you used it for a whole month. Okay? So in this case, once that's the purpose of expenses, is that once you spent the money to operate your business, you can no longer get that money back. So in this case, it will never close out either because you can't undo something that you already spent for the operations of your business. So these are called your temporary accounts because they close out at the end of a given accounting period. Your assets, liabilities, and equity will be your permanent accounts, okay? So let's go ahead and keep going, all right? Now we need to understand how our accounts are organized, okay? So of course, when we talk about having accounts, right, we have those account types, right? We have our assets, liabilities, equity, revenues, and expenses. Now, when we break it down even further, right, we can break them down into categories, okay? So this is what this is, okay? Or categories, and then when we expand it out the categories, right, then they become more and more. So this could be a subtype. This could, think of it like a chapter novel, okay? You can have chapter 1, but what is the breakdown topics and key points that arrive from chapter 1, okay? So that's the same idea here, right? We have a main account, which breaks down gives more meaningful information to your account type, right? Or it belongs in the account type. And what it does is it gives, a little more meaningful direction when it comes to creating a main account, okay? But when we talk about that, right? So a great example here, we got cash, right? We have accounts receivable. We have inventory. Those are main accounts. But in this case, they're very broad, especially inventory. What does inventory tell me specifically? Well, it tells me that I have inventory, but does it tell me what specific items I have under inventory? And that's where you can create your sub account, right? So my main account is an overall broad account, right? So I have inventory. And if I want to break down my main account to even further, I would create a sub account, okay? So again, when we talk about sub accounts, it just breaks down the main account and just gives it more detail, okay? And these details give it more detail to the actual account type, okay? So again, an asset, let's say for instance, right, that's my account type. Cash is something I own. Accounts receivable is also money that I own, right? Inventory, you're going to learn that inventory is going to be something that you own, okay? So this breaks down the account type by associating things that you own, right? Now again, after creating these, now they are going to typically flow in a certain direction, okay? And we'll talk more in depth on what I mean by this when we get to look at our accounting model, okay? So my cash accounts, my accounts receivable, my inventory, right? They all flow in a certain direction. My sub account, since it's breaking down my main account, they flow in the same direction as my main account, okay? But here's one account that actually does the opposite, and that's called a contra account, right? Think of it in real life English, right? Contra means like opposite or, controversy, right? That's exactly the same here in accounting, where if you create a contra account, the essence of a contra account is it could be a breakdown of either the main or sub account. So it could be either or. It could be a main account or a sub account. But the difference here is it flows in the opposite direction. So in this case, you see accounts receivable, right? That's money that we collect from customers, right? The contra account to that is going to be the allowance for doubtful accounts when your customers fail to pay you. All right? So we need to find a way to reduce or flow in the opposite direction of the main account. Okay? So a contra account could be a main or sub account. It doesn't necessarily have to be a particular account, right? It could be either or. But what the idea here is it flows in the opposite direction. Okay? And what it does is it reduces the main account. Okay? All right, so now that we understand this, right? So think of it like looking in the table of contents, right? You have chapter 1 is the account type. You got bullet points or topics, right? So in this case, I could say the first topic that I taught in chapter 1 was business organizations. Then my sub account would be those listed 5 business or organizations. Okay, so think of it like that, a table of contents. Okay. All right, then another concept we need to learn here is understanding the difference between what a debit and a credit does. Okay, now this is going to be one of the more difficult concepts to understand because in reality, right, debit is portrayed as something else. Credit is also portrayed as something else, especially if you're dealing with your bank account, right? When you credit someone's account, you're increasing their money, right? When you debit someone's account, you usually either decrease or increase it. In this case, we need to understand it as this, okay? Debit means left, credit means right. It does not mean it to increase and to decrease, okay? Debit does not mean to increase. Credit does not mean to increase either, okay? Because in this way, right, we have to look at in context of what account we are looking at. It also is also in terms of looking at who we are in the business world. Are we the vendor or are we the customer? Are we, or what's our position? Are we the provider of service and products or are we the purchaser of services and products, right? That's going to be a huge difference. So again, as us, when we look at putting money into our bank account, right, that credits our bank account. Why? Because in this case, we are the customer. But when we are looking at the bank standpoint, what we are essentially doing is we're debiting our bank account, okay? So yeah, while that sounds so confusing, you need to understand a debit can be either or, decreasing or increasing. You just have to look at what specific account type you are dealing with because a debit could mean either or. Same thing with a credit. A credit could mean increase or decrease. It just really depends on what the account type is. Okay, so never refer debit as an increase and credit as a decrease because it depends on, again, the asset or the liability, whatever account type that you're dealing with, okay? However, for this, just know it is left and it is right. Okay? Then again, like I've mentioned in chapter 2, the importance of the accounting equation. Again, the accounting equation is assets equals liabilities plus equity. Okay? This equation must hold true at any given point in your business. Okay? This accounting equation ensures a lot of your accounting accuracy, all right? Making sure that you've done your accounting correct. Because if your assets do not match your liabilities and equity, you have a problem. You either recorded something incorrectly, you forgot to record something, but something has gone wrong because, again, it's not balanced, okay? And this is very important, especially when you do compute or create your balance sheet, right? Because it's relying on this exact formula that your total assets is going to equal your liabilities plus your equity, right? We took a look at this yesterday in the financial statements. So in this case, this accounting equation, whether you are doing your balance sheet or not, must hold true at any given accounting period. Okay? All right? It must be balanced. Okay? Any questions so far?
No. No.
Now let's go ahead and talk about your assets, liabilities, and equity, okay? First off, let's talk about assets. Okay? Assets, as we know, is going to be everything that you own, right? I've talked about property, right? So if you buy furniture, you own it. If you buy inventory, you own it. If you have cash, it's in your bank account. So that means you own that money. Okay? So anything that you own is going to be an asset. Now, as we look further down into assets, it's broken down into categories, okay? And these categories, okay, are separate from your main accounts and sub accounts, right? This is going to help you further, again, break down your assets into sections for your accounts to fall under, okay? And how we determine it is going to be based on liquidity, okay? So what does that mean? Liquidity means how easily or how readily available or quickly convertible it is to cash, okay? So again, cash is going to be at the very top of the list because it's already in its liquid form. It's already cash, okay? Inventory, right? We understand that, well, if we have inventory, I can easily sell that right back out and I would receive cash out of it, okay? So that's how we understand how we organize our accounts even further by categories based on how liquid these assets are. So again, you have 3 categories, okay? Current asset, fixed asset, and other asset, okay? So again, I gave you a bunch of examples of a current asset. It's something that you can easily convert into cash within the year, right? All right? So that's easily convertible, right? Again, inventory. I can easily sell that and turn it around in 24 hours and it becomes cash instantly, right? So that is how we categorize our accounts even further as a current asset. Now, the next category is going to be a fixed asset, okay? Fixed asset, also known as PP&E, right? Property, plant, and equipment, okay? Property meaning any land, your streets, your sidewalks, your parking lots, okay? Your plant is going to be your building and everything that's inside your building. So your furniture, your desks, your lamps, okay? Your tables, your chairs, okay? And then you have equipment, which is usually anything that is a machinery. So maybe a refrigerator, okay, a printer, all right. Anything that has some kind of technology in it usually is an equipment because it's like some kind of machinery. So then again, if you understand those three things right there, property, plant, and equipment, right? That's gonna easily make it more easier for you to understand it's a fixed asset. Okay. And another thing that you can note here too is that these fixed assets usually have a life of its own, right? If you buy a printer, right? How long is it going to last you? It has age as well. And we'll talk more in depth about that in depreciation in chapter 11. But in this case, and it's tangible, right? You can touch a building, you can touch a street, you could touch a lamppost, okay? And that's what's going to make it unique. Now, in this case, right, let's put it in context why we would categorize these types of assets under fixed assets. Now, if I give you an example, if I buy a furniture, right, and I used it, how easy is it to convert back into cash?
Not as easy.
No, definitely, exactly. That's correct. It's going to be definitely not easy because then what do you got to do? Especially if it's used, you have to put it on a marketplace, a market platform. The person has to go and see the furniture to check it out themselves. You guys have to go into agreement terms. Then you have to schedule, okay, when are you going to pick it up? Or do you need me to drop it off? Then once you do that, then the money gets exchanged and so on and so forth. And it can take weeks, right? Or months even to sell something. That's not like you put it on the marketplace and someone's going to grab it right away. No, it takes a lot of time. Same thing if you're in the property management, right? If I'm trying to sell my building, how long is that going to take? That can take almost up to 2 years because it's got to go through escrow. Escrow, if you don't do it quick enough, you have 6 months holding period for escrow, right? They have to do background checks on your bank account and the buyer's bank account. They got to make sure that everything can go through. You got to pay for escrow fees. Especially selling a building is going to take the most longest type of way that you can convert into cash. So there's a great example, okay? It takes a minute to sell and get your money back out of it, okay? Then we have the last one, which is going to be other assets. Usually, typically, these are for anything that has indefinite life, okay, or a definite life, excuse me. And usually, these are your intangibles, okay. So again, that means you can't physically touch it, and these are your other assets, okay. So what is going to be considered an intangible? Intellectual property is an example, right? A patent, a license, a copyright. Now, all of those, can you actually touch those? Can you physically touch a patent? Can you physically touch a copyright?
No.
No, because what you really get is a piece of paper that says, okay, you have legal rights to this, you have a protection plan on it, but can you actually physically touch that plan? No, you can't, right? So in this case, and usually these kind of assets, right, they have a given life point, right? Again, a patent can maybe last only 5 years. A copyright can only last for 20 years, right? It has a definite life, and it is, you can't, the key factor here is now, especially when you go into copyrights, right? Can you get money out of it easily?
Yes.
It depends, because it depends what that copyright is. But what if it's, excuse me. Okay, so when we talk about copyrights, right? Copyrights is a legal protection. when you go into a legal rights and things, right? Because it's a protection, right, of your idea, your thoughts, or whatever product that you've already purchased, right? Can you get money out of it? I am not talking about a license where you can let other people expand out to it. I'm talking about if I want to get rid of my copyright, is it going to be easy for me to convert into cash?
No.
No, because you have to go through the lawyer. You have to go through, legal issues, a lawyer. You have to go through a lot of battles to get rid of your copyright, even if you want to abandon your copyright. But again, a lot of the times too, when your copyrights are infringed too, you have to go through all of those lawsuits too to get money for it. But at the end of the day, when does it usually come back at you? It could be a long time, right? You might not be able to get your royalties until 5 years down the line. So in this case, copyrights are going to be one of the longer ways that you can to be able to receive money, especially if you're trying to scrap it off. Okay? And then another one is going to be, what if you decide to prepay your landlord, right? So that's going to be an example of a prepaid account where I bought my property, or I rent out this property. I gave my rent money to the landlord for 5 years, but for some reason I'm having issues with my landlord. Do you think I'm going to get my money back?
Heck no.
That is the hardest one that you're ever going to get your money back, because you do have to go into court with that, especially if your landlord's not doing it, especially because, again, you guys signed the contract, you made an agreement, yada, yada, yada. You guys get the point. Okay? All right, so that's your assets. Okay? Any questions in regards to assets?
No.
Okay? So again, liabilities. Liabilities are going to be things that you owe. Now, do not ever refer your liabilities as debt, okay? Because it's not really a debt. In real life, yeah, we understand that anything that we owe to other people is meaning we got debt. But in this case, when we are referring it into a business standpoint, these are obligations. As in, yeah, we have debt. Do we have to pay it? Not all of it. But as a obligation, yes, you have to pay. It is an obligation that we owe to other people, right? So that's what you have to understand here. It is more or less debt, but when we understand it in accounting, we understand it as an obligation. It is our duty to have to pay back our loans. It is our duty that we have to pay the government for collecting sales tax, so on and so forth, right? So what's a liability? Is everything that you owe, all right? Now, this only has 2 categories, okay? Current and long-term liabilities. Not short-term, it's current, all right? Current is going to be in terms of how long you actually owe for this person, okay? So in this case, if you owe money to an organization, an individual, a vendor, a supplier, whoever, right? Usually it's owed within a year, okay? So typical ones are going to be like your 30, 60, 90 days kind of ordeal, okay? Other things could be 6-month long ordeals, okay? So again, that is just an example of a current liability. Is those kind of organizations typically you would owe them within a year, okay? A long-term liability will be things that you owe longer than a year, okay? So this one is going to be a typical loan, right? Usually loans are standard, either 3 to 5, or even if you're renting out a building, or in this case you bought a building, that could be anywhere from 30 to 60 years, right? That is way over a year. So that's how we categorize what our long-term liabilities are, is that anything that we owe longer than a year is going to be categorized there. Okay? Straightforward. Okay. So, next is going to be equity. Okay? Equity, okay, so we kind of have to understand this here. Equity has no categories, okay? But here are things that, or examples that affect equity, okay? Remember, these are not categories, okay? Equity has none, especially under owner's equity, okay? If for any reason that you are deciding to go into corporate, then yes, you will have categories, right? You'll have, your retained earnings, your stockholders' equity, and yada yada yada. But in this case, no. Because we're looking at a sole proprietor, a very small business, you will not have any categories. However, these are things that affect your equity is going to be, well, first off, what is equity? We talked about this, right? Equity is going to be the value of your company. So what will affect it is when we have capital contributions, right? Our net income increases if we decide to, again, reinvest money into the company, right? Your original investment is going to affect your equity, right? How much money are you going to put into your company, right? And of course, money that you take away from your company, a net loss is going to take away from your company. So again, these are going to be examples of how your equity is going to be affected, just like what I showed you in the previous one, right? What are examples of those accounts that affect my liabilities? This is the same thing. I'm giving you a bunch of accounts that, in essence, either increase or decrease your equity, okay? But in this case, equity does not have any categories, all right? Any questions so far?
No.
Okay. So now we're going to talk about income, okay? What is income? All right, in accounting, income and revenues usually are you can interchangeably use that word, okay? Because income is a way that we generate revenue, right? Or we generate income, what we pull in to the company. So whether you refer as income or whether you refer as a revenue, right? In this aspect, we're looking at net income, right? We're looking at making a profit, okay? And that's going to be your temporary accounts, which is your revenues and your expenses. Now, your revenues absolutely have two categories. In this case, we kind of refer them as three, but other and non-operating revenues are more or less interchangeable. Okay, so again, what is a revenue? A revenue is a means for you to generate income for your business. So what is the main core of operations when you do generate revenue? In this case, because we are looking at a merchandising type of business, our main core of operation, our main reason why we're generating income is because we are selling products, okay? Whether we sell products or provide services, we sell our services. So in this case, sales is going to be our main core of operations, and that's our means to generate income, okay? Anything that has to do besides sales is going to fall under the category of other or non-operating revenues, okay, or non-operating income, okay? So again, do we have an example of an other operating income? In this case, we will look into one for our fictitious business, but in this case, it is not necessary for you to actually really know, just because if you want to have other income from another source, okay, then you will categorize it there. Now, I'll give you an example right now. So, for example, when you merge into another company, right, you have a sister company and a parent company, right? What another income is you're taking, maybe you invested stock in another company, and when they generate money, right, and they disperse dividends, that's going to be considered money that's going to help you earn, right? Because you bought stock from another company and you're taking that money to capitalize your business, right? To let it generate revenue. That's going to be another income because your main core of operation isn't to invest into another company, right? Your main core is that you're selling a product. So that's an example of other income. Then what are expenses? So as I've mentioned before, expenses are a way to spend money for the main core of operations. It's to use your items. It's also to get rid of your items, okay? So in this case, when we're looking in aspect of an expense, right, we're determining that it's gone, it's used up, it's already been spent. We're trying to measure that, and we do that through an expense, okay? Expenses has two categories: cost of goods sold, COGS for short, and the operating expenses. Non-operating expenses is a possible category, but in this case, we won't see many examples of a non-operating expense, but I'll give you one anyway. Okay, so again, cost of goods sold is when you directly sell your inventory items. You need to calculate how much it's going to cost you to get rid of those items. So in this case, cost of goods sold is directly correlated to your inventory. All right, so when I say I sold my inventory and I got rid of it, that's where I use the cost of goods sold. Okay, and that's how I calculate my items, okay, to get rid of it out of my inventory account. Okay? Operating expenses are going to be any means that you spent money for the main core of your operation. So again, you need if you need to pay rent expense because you need a building in order for you to sell your products and services. Okay? You need to do a purchase expense to buy the inventory items that you need to sell in your store. Okay? So these again are operating expenses. A non-operating expense is when you pay for something that has nothing to do with the main core of your operations. So an example is if I decide to rent out a warehouse facility, okay, to hold my inventory, okay? That's not the main core of my operations. I'm not in the business to hold inventory. I'm in the business to sell inventory. So in this warehouse, okay, that's maybe not a part of my actual company. Maybe I had to rent it and it's a few blocks down from the street. That kind of renting facility, right, I have to pay for the building itself. Maybe I need to hire someone for security to protect my inventory items. I may need to have a temperature controlled room if my items and inventory are perishable or not. Okay, maybe it does, a lot of things last longer when they are cold. Okay, so again, that's going to be considered a non-operating expenses because yes, it is in essence kind of related to your business because it's storing the items of inventory that you are using to sell, but it's not your main core of operations. You're not in the business of holding inventory, like I've mentioned before, right? You're in the business of selling inventory. So then this is going to be considered a non-operating expense because you have to pay for those facility expenses. Okay? Any questions? So this is where I'm talking about the accounting model. So when I mentioned to you, when we looked at our main accounts, sub-accounts, and contra accounts, this is what I mean that a specific account is going to flow in a specific direction, okay? And we call this the normal balance, okay? The normal balance is whichever side that typically is increased on in a specific account is going to be the normal balance. So an example here is an asset, right? What normally increases an asset? A debit increases an asset. So that means that makes it the normal balance, okay? Meaning every time I use an asset account, you typically are more likely going to be using a debit. Okay, when I purchase inventory, that's going to increase my assets. When I buy furniture, that's definitely going to increase my assets. Okay? But in this case, right, we need to also understand that a debit and a credit can affect a particular account. Now, in order for me to acquire those assets, I have to buy it. I have to spend money. Money is considered an asset. So I would also have to credit my account because I'm exchanging my cash into buying my furniture, my machine, my building, okay? So in this case, that is where you have to understand. That means I gotta dip into multiple accounts to make this work. In this case, when we understand assets, right, we need to understand that in order to increase an asset, you're going to debit the account. If you're going to decrease an asset, you're going to credit the account, okay? Now, every single scenario will not apply, right? Let's take a look at liabilities. Liabilities, in order to increase a liability, this time I have to use a credit, okay? And a debit would decrease my liabilities, okay? So again, if I end up borrowing money, then I have to say I increased my liabilities because now I owe the bank money. But if I pay off that loan, I'm going to decrease it using a debit, okay? So in this case, right, if you actually take a look at it, to kind of sum it up for you guys, right, your expenses and your assets are the only accounts that you're going to be that flow in the same direction. So that means they are increased by debits and they are decreased by credits. Okay? While your liabilities, your revenues, and your equity flow in the same direction too. They are typically increased with a credit and they are typically decreased with a debit. Okay, so in this case, if you can memorize it like this, this is going to be very, very important for you to have. Okay, for when we dive into actually learning how to journalize and record our transactions, this is accounting model is going to help you understand the flow of direction, especially when we understand how we're going to use the transaction, understand it, sort it, and then organize it. Okay. So again, this is, I believe it's page 2 or page 5 of chapter 2. I will provide you guys a separate worksheet that you guys can print out. It's just the accounting model. So then when you guys are practicing, because we will be looking at a fictitious business, I expect you guys to have this in hand. So then it makes it easier for you to, understand a transaction. Okay. So let's go ahead and talk about the bookkeeping system. Okay. A bookkeeping system, right? We have two methods. We have the single entry system and we have the double entry system. Okay. A single entry system only records a transaction in one account. Okay. Hence the word single, right? And then a double entry allows you to enter in a transaction using 2 or more accounts. Okay? So let's think of an example, okay? When I am using a single entry account, right? A good example is like using a checkbook. The checkbook, right, allows you to write your checks, right? And usually your checkbook will come with like a little ledger paper flappy thing that is at the top of your checking book. Once you cut the check, you only record it at the top of the ledger, right? You're only saying that I wrote a check out to buy something, okay? What does that tell me? Does that update my checking account, or does that tell me that I'm updating my my expense? In this case, I'm only recording it that I spent the money. I only record it because that's only one place I'm entering in, and that's my checking account. Okay? We call this the single entry. Now, let's take that instance and apply it to my double entry. Okay? If I decide to write a check for the purposes of paying for rent, right? Then this is what I'm going to record it in. I already have written it in my check register, so that means I already spent the cash. Now, this time I'm going to create another account called rent expense because again, I had to spend money in order to operate my business. And how did I do so? I paid for rent. So therefore, I'm tapping into 2 or more accounts, right? Hence the word double entry, right? I have a debit in my rent expense account and I have a credit in my checking account. Okay? So in this case, I'm recording the transaction in 2 different accounts. And this is where the infamous rule of your total debits must equal your total credits. Okay? This is where, if you think about it in real life, okay? I'm buying something, okay? I'm exchanging something, right? If I need to pay rent, what am I doing? I need money in my bank account. I'm writing a check. I give it to the landlord. What was the price? That's the same idea here. We're understanding that, okay, I had to spend money in order to obtain rent. Okay? And I had the equal amount of my rent money, right, paid or taken out of my checking account and putting it into my rent expense account. Okay? Equal debit to my equal credit. Okay? So again, that's using the double entry system. And what we do here in accounting is we are going to be using the double entry system. And this is why when we use the double entry system, everything starts to get connected, right? We understand why things need to be balanced. It's because of this method right here, right? The first rule of thumb is, does your debits equal your total credits? And it has to at all times. If not, you have an error here, okay? And that's exactly why my books must always be balanced, right? If you ever heard of that terminology, my books always have to be balanced. My checking always has to be balanced. My balance sheet always must be balanced, right? The accounting equation must always balance, right? It's because you're transferring certain amount of dollar bill into the same exact or another account with the same exact amount of dollar bill, okay? Right? I'm not going to record saying if I bought a coffee for it was worth $5, it was worth $4.98. I'm not going to say I spent $5. No, because I spent $4.98 and I got 2 cents back. Okay? That's the idea here. Okay? All right. Then we are done with chapter 1. What did we learn, or chapter 2, excuse me. What did we learn? Well, we went over what accounting is. Okay? We went over the 5 account types, your asset, liabilities, equity, revenues, and expenses. We talked about what debits and credits do. We talked about the normal balance, right? Whichever side is the positive side is considered your normal balance. And then we talked about the different categories that fall under each account, and we have it separated by your permanent and your temporary accounts. Okay. All right. Any questions in regards to chapter 2?
No.
All right, let's go ahead and do the exercise. Okay. Chapter 2, okay? What are the 5 types of accounts?
Assets, liability, equity, revenue, expense.
Good. Okay. All right. What is a main account?
It gives meaning into the account type.
Good. Gives meaning to account types. Okay. All right. Well, okay, that I get. Okay. What is a contra account?
Opposite.
Opposite, right? Opposite of what? So it flows in the opposite direction of a main or sub account. Okay, so again, if I have a debit in one account, that means the contra account is going to be a credit. So in this case, to tack on a little more information to the main account, I'm going to say flows in a specific direction. Okay. All right, what does left mean?
The left side of the ledger for debit.
Debit, good. What does right mean?
Credit.
Yes, good. Okay. All right, and then in chapter 3, you'll understand why these are referenced this way. Okay. Number 6, what is the accounting equation?
It's liabilities plus equity
Okay,
equals assets.
equals assets, good. Okay. Number 7, what are the 3 categories of assets?
Is one of them cash?
Cash is an account, not
Okay.
a category.
Okay. Current asset.
Current assets, good.
Fixed assets.
Fixed assets, good. What else? And other, good. Okay, number 8, what are the 2 categories of liabilities?
Current liability.
Mm-hmm.
Long term.
And long term, good. There's no such thing as short-term liabilities. Okay. All right, it's current. Number 9, okay, what are the categories of equity?
The total value.
There are no categories.
There are no categories. Excellent. Okay. Number 10, what are the categories of expenses? Or, yes, expenses.
Revenue, expenses.
We're talking about expenses. What are the categories of expenses?
All expenses need to operate a business.
That's the definition. I'm asking for the category.
Oh, no operating
Non-operating.
expenses.
Is it cost of goods sold?
Cost of goods sold. What else? One more.
Operating expenses,
Okay, good.
rent expenses, purchase expenses.
Those are accounts under operating expenses. Okay, so in this case, number 11, what are the categories of revenues?
Non-operating
Non-operating,
revenues.
or also known as other. And what else?
And operating?
Operating. Good. Number 12, what are the two accounting systems?
Single entry?
Single entry
Double entry.
and double entry. Good, excellent. Okay. And then 13 is, what is the normal balance?
Asset equal liability and equity.
That is the accounting equation.
It's your assets.
What is the normal balance? It's a definition.
Oh, all the debit must match all credit.
No. In this case, this is referring to the accounting model. What is considered a normal balance?
How much?
It's the positive balance that increases in any specific account.
Excellent. The positive balance that increases in a specific account. Good. Okay. And then number 14, examples of accounts for the following for the following exercises. So again, this is what I want you guys to do. For this exercise, right, I have a list of a whole bunch of accounts and I have a definition of what each account is, and your job is to determine the account type, the category it belongs to, and what is the normal balance in that specific account. So in this case, this is using your accounting model. Here gives you the list of what the account types are, and the second one gives you what the account categories are. Okay, so again, we already talked about the categories, right? We listed all of them at the top of there, and we looked at all of the the account types. Okay, so in this case, let's go ahead and practice this because this is going to be more or less what is going to be on your exam. Okay, I will be asking you a question, right, on this specific account, and I need you to determine the account type, category, and the normal balance. Okay, so let's take a look at the first one, your checking account. Your checking account is going to be money in the bank. Straightforward, right? Your checking account. So what account type would that be?
The assets.
Yes, it's an asset because you own the money in that bank. Okay. Now, what kind of asset?
Is it current?
It is current because it's already in its simplest form. Okay. Now, would this typically normally have a debit balance or a credit balance? How would you increase an asset?
Credit?
Try again.
Debit?
Yes. So in this case, this is where your accounting model is going to come into play because when I ask you, how do you increase an asset, right? You're going to refer to your accounting model. Okay. So in this case, if I refer to my accounting model, debits increase my assets. Okay. Because the definition of a normal balance is whichever side that increases in a specific account. Okay. So in this case, debit. Okay. Accounts payable, okay? Money that you owe to vendors.
Liability?
It's a liability. Okay? Now, what kind of liability would it be?
Operating?
There's no such thing as an operating liability.
Okay.
For fixed,
There's no such thing as a fixed liability either, right? Let's go back
Right.
and refer to what you guys learned up here, right? What are the categories of liabilities?
current and long term.
Current and long term.
Money you owe to vendors. Wouldn't that be current?
It would 100% be current because you're owing to your vendors. Vendors are not going to let you owe them for a whole year to supply you whatever they need to supply you. So in this case, correct. That is a current liability. All right. So then, does this have a debit or a credit balance?
Credit.
It would have a credit balance, right? Because we increase our liabilities using a credit. Okay. What about copyrights? Copyrights are legal documentation of ownership or right.
Assets.
It is an asset, correct, because you own it, right? Now, what kind of asset would a copyright fall under?
Long term.
There's no such thing as a long-term asset.
Other income.
Other, not income, but other asset, yes. Okay? Because again, the unique thing about this is that it's intangible, but you still own it, right? Now, debit or credit balance. How would you increase an asset?
Credit?
Not a credit. Debit. So refer to your accounting model. Okay. So in this case, supplies. When you need to buy supplies, okay, that are needed to operate the business.
Expense?
It is non-expense. When you purchase supplies, right, what happens to those supplies? They're your supplies, aren't they?
Assets.
It is an asset. Okay. Now, what kind of asset would this be?
Current.
It would be current because, again, you're not going to hold on. This supplies are very easily convertible into cash, right? Whether you use it for your operations, then you can easily get rid of it right away. So whether you get cash out of it or whether you expense it right away, it's going to be a current asset. Okay. Debit or credit balance. How do you increase an asset?
Debit.
With a debit. Good. All right. Loans. Okay. Owing money to a bank for over a period of time.
Expense.
Not an expense.
Liability.
Yes, because you owe money to the bank, right? Okay. Now, is this going to be a current or a long term?
Long term.
It's most likely, most loans are typically going to be long term. Okay. Now, is that going to be a debit or a credit balance?
Credit.
Credit. Good. Right. You increase liabilities with a credit. Okay. What about an accounts receivable when customers owing the company money? Okay, so you can sell your items to your customers and they owe you money, right? That's what an accounts receivable is.
Revenues.
That's a confusing thing here. It is not a revenue.
Owner's equity.
It is not an owner's equity because how is customers owing you money going to increase the value of your company?
Asset.
Yes, because in this case, you own this cash that people owe you the money for, right? It's your money. You can go to them and bill them and be able to receive cash from them instantly. Okay? So in this case, what kind of asset?
Current.
Current. Good. So this, in other sense, is cash that is owed to you. Okay? Now, how do you increase an asset?
Debit.
You use a debit. Good. Okay. Okay, now this one is an owner's withdrawal, where you're taking money out from the business. You're taking money out from the business.
Expense.
No, it's not an expense.
Owner's equity.
Owner's equity. Good. So I'm going to put owners. Actually, I'm going to do equity, okay? Now, in this case, what category would this belong to?
Other income. No, sorry.
No other income.
Or operating.
There's no operating equity.
Current.
There's no current equity. So again, refer to what you guys answered from above. How did you answer? What are the categories of equity?
Or other.
There's no other equity. So let's take a look, okay? What did you guys answer for the categories of equity?
Long.
Oh, none.
There's none. There's no categories under equity. Okay? So in this case, none.
No one.
Yeah, nothing. All right? All right. Now, would this typically have a normal balance of a debit or a credit? Now, let's read the account very carefully. You're taking money away from the business.
Debit.
Yes, it's going to flow in the opposite direction because this right here, you're taking money away from the business, right? You're not increasing your equity, you're decreasing it. So in this case,
Subtracting it.
you're subtracting it. So in this case, you're going to decrease it with a debit. Good, right? All right, what about advertising expense? Okay, marketing for the business.
Expense.
It is an expense. Good. Okay. Now, what kind of expense?
For operating.
It is for operating. Okay. Now, how would you increase an expense account?
Debit.
Debit.
Yes, you would debit the account. Good. Right? Okay, what about a cost of goods sold? Okay, the cost of items that you sell. Straightforward.
Income.
Not income, because this is the
Revenue.
cost, not a revenue.
Cost of the cost of its items. It is owner's equity.
No, because how does the cost of my items sell affect the value of my company?
For expense.
Expense.
It is an expense. Okay? Because in this case, I need to figure out how much it costs me that I have to get rid of my inventory for, right? So in this case, what category would that belong to?
For the cost of goods sold.
Yes, COGS for short, okay? Now, how do you increase an expense?
Debit.
Yes, with a debit. Good. All right. What about inventory? Inventory are items that you purchase that you plan to sell. Let me check, okay. It's an asset, right? You have intent to sell it, but when you purchase them, they become yours. Right? Now in this case, what kind of asset would an inventory item be?
Current.
It would be current because you can turn it around and sell it for cash. Good. Now, how do you increase an asset?
Credit.
How do you increase an asset?
Debit.
You use a debit. Good. Okay. What about land, which is your property?
Asset.
It is an asset. Now, what kind of asset does this belong to?
Long term.
There's no such thing as a long-term asset. Okay, so let's take a visit to what those categories of assets are.
Current.
Okay, no, it's not current because if I buy land, how quickly can I convert this into cash?
Other.
It is definitely not other. It has it. You can physically
Long.
touch land.
Long.
There's no such thing as a long long asset. If it's not current and it's not other, then what is it going to be?
Operating.
No, let's take a look at the categories for assets again. What are the three different categories?
Long term.
There's no such thing as a long-term asset.
Oh, okay. It's current.
It's not current. Okay, let's take a look. Number 7.
Fixed.
There are 3 of them, right? We got current, we got fixed, and we have other. If it's not a current and it's not other, what is it going to be?
Not nothing.
Uh,
None.
No,
Fixed.
it's going to be fixed. Because fixed, remember, we talked about this. Fixed assets, a best way to determine whether it falls under that category is property, plant, and equipment, right? Property is going to be anything that is your land, your street, your sidewalks, okay? Your plant is going to be the building and everything that goes inside the building. So your lamps, your desks, your chairs, your tables, okay? And then again, your equipment is going to be any type of machinery that helps you operate your business. So in this case, this is land. So this is going to give me a fixed asset, okay? And then last here is going to be, how do you increase an asset?
Debit.
Yes, debit. Okay. All right, what about sales? When you earn money from selling a product or service?
Asset.
Not an asset.
Revenue.
It's your revenues, right? It's when you sell your items and you earned your sale, right? Okay, now what kind of revenue?
Current.
No.
Cogs.
Not a cost of goods sold. That's an expense, remember?
Current.
No, she already said current already. So in this case, let's take a look at what those categories of revenues are. Okay, categories of revenues.
Operating.
It's going to be operating, right? Because it's the main core of your business is you sell products and services. So it is 100% operating. Okay? Now, how would you increase revenues?
Debit.
No.
Oh.
So again, refer to your accounting model. How would you typically increase a revenue? With a credit. Okay. So what about a capital contribution when you invest money into the business?
Asset.
It is not an asset. You're investing money
liability.
into the business. Are you owing anybody money when you invest?
No.
No.
Revenue.
It is not a revenue.
Expense.
It is not an expense either.
Owner's equity.
It is an equity because we're changing the value of my company, right? I'm investing money. I'm just putting pure money into the company. So in this case, that's going to increase my equity. I'm adding value to my company. Now, what category does this belong to?
For operating.
No, not operating. Equity.
Current.
There's no such thing as a current equity.
Other.
No, there's no other equity. Okay, let's take a visit back up here again. What are the categories of equity?
Fixed.
Not
None.
fixed. There's
There isn't
nothing. There's no categories under equity. So in this case, none. Okay, so then how do you increase equity?
Credit.
Yes. Okay. All right. What about equipment? Any machinery or object to run operations?
Expense.
No. You're buying a machine to operate your business. Okay?
Owner's
Or
equity.
Oh, I said
it's an asset because you own the machine now, don't you? So in this case,
item.
assets. Good. Now, what kind of asset? Remember, this is a PP&E.
Current.
This is a PP&E.
PP&E. So it would be fixed asset.
It's a fixed asset, right? Because it falls under the category of a property, plant, and equipment, right? It's straightforward. It's equipment. So in this case, it's a fixed asset. Okay? How do you increase assets?
debit.
Yes.
Debit.
With a debit. Okay. What about a notes payable? Where it's IOUs to other people.
Liability.
It's a liability. Okay. Now, what kind of liability would this be?
Current.
It could be current. Okay. So I'll give you this one. It could be current or it could be long term. Okay. Why is that? So here with an IOU, right, you can always choose to defer payments, right? That's the difference between a loan and an IOU, right? If you owe somebody for 6 months, right, you could say, oh, can I extend my payment? Can I defer my payment for another 6 months? Yes, you can. Okay, where a loan, that's a little harder to come by, right? That's a little more difficult, especially if you're not going to refinance anything, right? So in this case, this kind of IOU, you can have the capabilities to fluctuate the time that you owe them. So it could be a current, it could be long term. Okay? And how do you increase a liability?
By credit.
By a credit, good. Okay. And then let's see, what about rent expense? Okay, paying for rent.
Asset.
No, it is not an asset. You don't own the rent.
Expense.
It's an expense. Good. Now, what kind of expense would this be?
For operating.
It'll be for your operating. Good. Okay. All right. Debit or credit? How would you increase an expense?
Debit.
With a debit. Good. Okay. All right. 2 more. What about delivery income? When you charge your customers for to cover for delivery.
Asset.
No, it's not an asset. You don't own anything when it comes here.
Revenue.
Expensive.
Revenue? Good. What kind of revenue?
Current.
There's no such thing as a current revenue.
COGS.
No, that is an expense.
Oh, for operating.
Operating, in this case, no, because are you in the business of delivering stuff to customers?
No.
So what would that be instead?
Other.
It'd be other income.
Okay.
Good. All right. So now, how do you increase revenues?
Credit.
Credit. Okay. And then last but not least, we have purchase expense. When you make purchases for the business operations, okay, or for inventory items.
Asset.
No.
What is different between the we purchase something, an item, and this one? Is it the same asset?
That's exactly what it is. I'm buying. I'm making a purchase for the business.
For owner's equity.
That's for the value of the company.
Expense.
Yes, it's an expense. Okay, so to answer your question, right, it's not the item I'm having, right? If it's inventory, right, that means I already acquired it. I already purchased it. I have it ready, available to sell. That's different than purchasing it, right? When I'm using a purchase expense, I'm making an expense for the business in order to buy inventory, okay? So that's one of the accounts you're going to be using in order for you to increase your assets. Okay? So in this case, this is when you're making a purchase for the business. So in this case, it's an expense. Okay? Now, what kind of expense would this be?
Other?
It's not an other expense.
For operating.
It is for operating, right? You need to have inventory in order for you to sell your items in your store, right? So this has to be 100% operating. So would it normally have a debit balance or a credit balance?
Debit.
Debit. Okay? So let's go over this real quick. Now I see that you guys have struggling. That's okay. It's the first couple this is the second day technically in regards to looking at these items. I don't expect you to perfect this because again, it's a learning process. However, I'll teach you a technique for you to be able to understand or be able to categorize these much quicker. Expenses are always going to have the word expense at the end of it, okay? So in this case, that will be your easy one that you'll recognize is that typically they'll have the word expense at the end of it. Anything with the word payable, okay? Anything with the word payable is going to be a liability, okay? Because we said, right, payables mean you need to pay or you owe, okay? Another thing here is that the obviously for revenues, you're only going to have sales or some kind of other account for it, but most typically you'll only have sales for your revenues because again, that's the only operating part. Okay, so the only difficult thing that you have to do is knowing the difference between an asset. Now, in this case, you already can figure out most of these things, right? As long as you can think that you own it, then that's okay, right? Then you already got that one instance. Now, understanding how to categorize it, once again, it's based on how quickly you can convert it into cash, okay? So in this case, a lot of these things, think about it. Checking, I own that, right? Right? Copyrights, I own that. Supplies, I own that. Okay? So again, do I own purchase expense?
No.
No. Okay? You can't own an expense. So that's how another way that you could determine it, okay? And since you guys were very struggling as well, I do recommend you I have the course review sheets, okay? Here gives you the asset type as well as the categories that fall beneath it. Check out equity. I put it in capital letters, no categories. Okay? These two other ones are what affect your equity. Okay? So again, and then again, I told you that using the accounting model is going to help you to determine whether you're increasing or decreasing an account, right? As we mentioned, assets are always going to be debited. They're always going to be increased with the debit. Liabilities are always going to be increased with a credit, okay? Revenues are always going to be increased with a credit, okay? So again, if you remember this, assets and expenses typically flow in the same direction. All the other ones flow in the same direction. So if an asset's going to be increased with the debit, so are your expenses. Everything else is going to be credit, okay? But it also depends on the scenario too, like that. We had that one outlier example where we had an owner's withdrawal. Is that going to increase your equity or is that going to decrease your equity? In this case, that's going to decrease your equity, okay? Now, right now, we're not learning about contra accounts, but we will progressively go through everything and we will eventually come across contra accounts, okay? All right, so that is it for chapter 2 here.